Have you been wondering about the recent stock market jitters? There's been a noticeable decline from record highs in the stock market, which we often refer to as stock market jitters. This reflects a growing sense of anxiety and uncertainty among investors. So, what's behind these jitters? Firstly, inflation fears are on the rise, with the cost of everyday goods and services increasing, eroding the purchasing power of money. This has investors worried about potential impacts on corporate profits and higher interest rates. Secondly, the U.S. Federal Reserve is anticipated to raise interest rates this year to combat inflation, which could dampen investor sentiment and hinder company expansion plans. Thirdly, geopolitical tensions, such as the ongoing war in Ukraine and heightened U.S.-China tensions, are causing global economic uncertainty, potentially disrupting supply chains and impacting stock prices. Fourthly, the scrutiny of earnings season can lead to a sell-off in stocks if corporate earnings fall short of expectations. Lastly, some investors might be cashing in on their profits, contributing to a decline in stock prices. These factors have collectively contributed to a noticeable decline from record highs in the stock market. Now, let's delve into the potential implications of these jitters. As a reaction to these jitters, the market usually experiences increased volatility. This means that stock prices can fluctuate more significantly in the short term. It's like a roller coaster ride, with prices going up and down rather abruptly. So investors, fasten your seatbelts and prepare for some thrilling ups and downs. In the midst of this turbulence, there could be potential buying opportunities. It's like a clearance sale in the stock market. Stocks that were once too expensive may now be available at lower prices. So, for those long-term investors out there, these market jitters might just be the sale season you've been waiting for. But remember, during these periods of uncertainty, it's crucial to keep your eyes on the prize. Focus on the underlying fundamentals of the companies. Consider their financial health, growth prospects, and competitive advantage. While stock market jitters can lead to increased volatility, they can also present opportunities for long-term investors. How can investors navigate through a volatile market environment? This is a question that many investors grapple with during periods of stock market jitters. One viable approach is to stay focused on the fundamentals of companies. Look at their financial health, growth prospects, and competitive advantage. Instead of being swayed by short-term market fluctuations, consider the long-term viability and performance of the companies in which you invest. In addition, it's worth considering sectors that may be less susceptible to market jitters. These often include industries with essential goods and services that remain in demand regardless of economic conditions. Lastly, remember that market jitters don't last forever. They are often temporary responses to specific economic events or conditions. Patience can be a virtue in these situations, as the market tends to recover over time. By understanding the causes of stock market jitters and remaining informed about economic developments, investors can make informed decisions and weather the storms of a fluctuating market.